So good morning, everyone. For those who don't know me, I'm Ian Marcus, the president of CULS. We're waiting on one more speaker, but I think we're due to go live. We may even be so I'll behave myself accordingly at 8:15. Thank you for making the effort to do it in person. We do strongly believe that CULS is as much about networking as well as education. So hopefully there'll be some other broader benefits for those who've made the effort other than the bacon sandwiches. So thank you for joining us. We've no idea how many we'll have online, but obviously we're trying to make this as accessible to everyone as is possible. We're still waiting on one speaker, but I think we'll kick off as and when we're going live. Steve, I think it's all over to you, and then I'll come back at the end and just say a few thank yous there. But thank you all very much for making the effort and the early start and joining us. Steve, over to you.
All right. Good morning, everyone. I'm glad to say it's a bright morning. I was thinking to myself on the train this morning, I think this is about only the fourth time in 2 years I've put a tie on. And I was wondering to myself, do you think that the world is going to bounce back to that normality of stiff collar that we were used to? Or are we transitioning into a more relaxed, more collaborative, more remote and shared society? And we can see these things writ large now on the landscape. Time was, we'd all have ties on, and now that isn't the case, I'm pleased to say. Some would say that's a lowering of standards. Personally, I think it's a move in the right direction. Anyway, I waffled on. Good morning and welcome to this year's CULS breakfast. We've titled this "The Times They Are A-Changing" after the Bob Dylan song, which I'm sure you're familiar with, because as ever they are. One of the great things about the property market is it never stands still. There are always lots of external factors and forces which are shaping the environment within which we have to make decisions, make strategy and so on and so forth. But obviously in current times, it seems to me that the forces of change are accelerating and becoming more profound and more rapid. Our society is changing perhaps more rapidly than it has done for quite a long period of time. Not just because of the pandemic, but obviously because of Brexit and various other things as well. And that produces multiple signals, which we as real estate professionals obviously need to interpret and understand to develop that appropriate strategy. And it's not particularly easy. But what we're going to try and do is look at some of those things in the next hour or so. As ever, I'm immediately and terribly grateful for our panel who have made the effort to come along this morning and share their thoughts with us. I've looked through their material and I can promise you it's worth listening to. We are still waiting for Stephen from Easthill. I suspect he's been delayed, but we'll press on in any case. We'll start with Nick Knight, who's from CBRE, Director of their Valuations and Advisory business. Deepa joins us from the Public Sector Pension Investment Board from Canada. Stephen has arrived. Good morning, Stephen. Don't worry. Stephen, absolutely right on cue. He's just with us from Easthill Secured. And then Dan, who has relatively recently joined Great Portland Estate. The good thing about this profile is that all of these individuals are not just incredibly experienced, incredibly well qualified. I could be here all morning telling you about their credentials and so on and so forth. But there's a great deal of diversity and indeed a very strong international flavour this year, which is excellent. So we had North America and Canada represented and so on. We have the capital markets represented as well as the advisory sector and of course developer. And that is what these sessions are designed to do, is to bring together varied perspectives from different parts of the industry. Because obviously in order to create the built environment, it requires collaboration between a very wide number of stakeholders and so on and so forth. So we do try in a whistle-stop tour to give you a quick guide of the market. Just a couple of opening thoughts. This is one of the graphs or one of the indexes I've always followed for years and years, because as we know, property is closely related to sentiment. A lot of what happens in property is related to sentiment, and this particular, the PMI, Purchase Managers Index of construction, is one of those indices that's always struck me as being incredibly responsive to real-world signals. And you can see that immediately, obviously, as a result of the pandemic last year, when confidence in the construction sector plummeted to unbelievable lows. But what you can also see immediately here is that it has returned. Now, this is not a particularly scientific measure, I know it's not, but I've always found this particular index to be quite representative of what's actually happening in the wider market. So it does appear that although we exist in challenging and difficult times, there's considerable confidence in many parts of the property sector. There's certainly confidence in the capital markets. There's some returning confidence in development and so on and so forth. And yet at the same time, as we'll hear as we go through the various presentations, there are inevitably many signals and factors and influences which are shaping the environment within which we exist. Rising construction costs, carbon and obviously ESG, etc., have become huge issues. Supply chains we'll hear about, home working, remote working. Hello to everybody obviously out there in digital land and so on. Interest rates, yield gap, inflation. We are likely to be heading towards an inflationary period, it would seem, which would suggest upward pressure on interest rates. We'll probably hear about that. In historic terms, I don't particularly think that's necessarily anything to get hugely excited about. But nonetheless, some of the norms in terms of financial indicators that we have become used to over the past 10, maybe even 15 years, look like they may be starting to shift. And of course, we're also seeing re-engineering, I suppose, is a good way of putting it, in the retail market, the warehouse and logistics sector, and also downtown offices, as a result of both possibly the combination of the carbon imperative and also at the same time, clearly the result of the pandemic and the changes that this is wreaking on society. I'll just leave you with one sort of particular thought. I was talking to some colleagues recently, and I spend a lot of time in the public sector. And the public sector have got themselves into a bit of a pickle because they've overbought assets to put in their pension funds. Those assets are now declining in value because they're particularly exposed to the retail market. And then they've had a perfect storm where, as a result of the pandemic, many of their tenants have gone into default and aren't paying their rent. And that's had an impact on public sector finances and so on and so forth. And yet it's all not all doom and gloom. This was a deal that was done, it's nothing I was personally involved in, it's just something that somebody brought to my attention last month. Our DHL warehouse, you know, prime, lovely new building, logistics and so on and so forth, purchased by a European specialist, developer and fund. But look at the yield, 1.9%. I've never, ever in my career of 35 years seen any logistics transaction done at 1.9%. Now, it's very dangerous to cherry pick a particular transaction as being illustrative of the market. Clearly, it's not. There are probably special circumstances here that we're not aware of, but I'm seeing some of the numbers that are coming forward, perhaps questioning some of the long-term values that we've held. We remind ourselves that there is re-engineering in this sector, but property historically, been in it as long as I have and many of you have, has a tendency to overshoot on both the downside and the upside. So it tends to overheat when the market's improving, and it tends to be slow to recover when the markets are down. And I'm worried about yield compression in certain qualifying assets. Is that actually fair value? Just a point in the question to leave you with. But I'll shut up because actually the panelists are far better qualified than I am, and they'll walk you through the tightrope of their presentation. So we'll start off with Nick. Over to you. It's just that one.
Thank you very much, Steve. And I sort of echo your sentiments about being here in person. It is great to be here in person. My personal challenge this morning, though, was finding a suit that still fitted. I didn't even attempt the tie after that. But look, I built this as just a 10-minute talk, just to talk. I've titled it "COVID in the Rearview Mirror?" ? Because thankfully, I think the fact that we're here, we can start to look forward, and we have experienced now, close on 6 months since restrictions were lifted. And so I just want to spend a bit of time talking about the economic context, about what we're seeing in the marketplace, and then just touch on what the general outlook might be from here. So let's just start with the economic context. As I said, post-July, we have seen things open up, and we are now looking at our estimate for 2021 is about 7% GDP growth, which represents quite a significant rebound. But clearly, it hasn't all been plain sailing. There have been a lot of mentions of the 70s, and looking back to the 70s recently, we've all experienced or read a lot about supply chain issues and labour shortages really weighing on that economic activity. And it's not surprising when we read about 65 container ships stranded outside LA, unable to unload, similar sort of things happening at Felixstowe. that when the pandemic hit, the global supply chains, a lot of the practical things were stranded in the wrong places. And as demand has bounced back, it's obviously going to take some time for that to sort itself out. And that is one of the drivers of the inflation that we've seen in the market. Listening to the radio this morning, US inflation now at 6%, which is, in recent history, really quite significant. Now, a lot of the talk has been about how transitory or not that is. And it's clear that once the supply chains settle down, you'd expect some of the heat to come out of that. But I think people are now talking about it being around for some time. We have, I would postulate, a additional consideration in the UK, because I think Brexit adds additional pressure to that supply chain settling down. We saw with the HGV drivers, actually, when the government relaxed the rules and, we've seen wages rise significantly, it hasn't corrected very quickly, because it is just more difficult for that labour that's based in the continent now to come and work in this country. So I think there will be a little bit of overhang of Brexit. So I think interest rates will rise. Obviously, we look very closely at interest rates in real estate. But I think we need to put this in context. When we're talking about interest rate rises, I think certainly our house view is that we're talking about a return to pre-pandemic levels. We're not talking about a return to the levels pre-GFC. So whilst we might see some interest rate rises during the course of next year, we don't think that there's a significant move there, and we'll go on to it later. But obviously, the relationship between the base rate gilts and property yields, there's a very wide spread there, so there should be some possibility to absorb that. We've also seen the end of furlough and other government support tapering. That is happening at a time where we have record vacancies in the economy, so you would hope that balance has been called correctly by Rishi, but again, that will take some time to settle down, and we'll probably see wage inflation in the short term, continued wage inflation. So what does it mean in our markets? What does it mean what have we seen in the main markets, the main real estate markets? If you just look at the spread of outcomes here on the rents that we've had in that pandemic period, massive divergence, and we've never seen divergence on a scale like that before. Now, interestingly, since reopening, industrials has been turbocharged further. We've seen that take-up in activity has actually led to even more pressure on industrials. But actually, as we've on the other end of the scale, we've seen a slight tapering or softening in the pace of fall, or a stabilisation within retail. So I think those are the changes that I would highlight post reopening. But we're still in this place where we've got huge divergence of outcomes. And you can see it again on the yield side. So that's the rent side, that's the yield side. You can see the gap between, to pick up Steve's point, industrial yields and historic lows, and still very significant imbalance of demand and supply driving that down further. And the justification for those low yields is this anticipation of rental growth. And on the other side, we've still got the market still is struggling to underwrite rents going forward with retail. So that's where we are at the moment. If I just put these charts up to illustrate a bit about, in practical terms, what's happened post reopening. And there is some evidence of the reversal of COVID effects. So top left, we can see that online retail penetration has fallen back somewhat. Very high peaks for clothing and footwear during the pandemic. Household goods, very, very high peaks. They have fallen back, which must be good for physical retail, but they are still at higher levels than pre-pandemic. So actually the trend line remains up. So that's the acceleration of the structural change we talked about during the pandemic, I think is real, but it's good to see from a real estate perspective that that has fallen back recently. Top right, footfall not back to where it was pre-pandemic, but interestingly, a real difference between footfall in London and the other regional cities. Still a reluctance for people to return to London. If you compare the different retail formats, you've got a real divergence between shopping centre and high streets and the out of town format. So this is quite a complicated graph, but what it effectively shows is that there's a real preference for that out of town retail format post reopening, and I think that's about people feeling more comfortable in their private transport. I think it's people feeling more comfortable shopping in what are perceived to be much less crowded and more spacious formats. And then the last one here, which I think is quite telling, and this may be a point in time, but actually we've seen very high rates of store closures in the UK over the last 3 years, and to the half year in 2021, that was much lower. Now that might be an indication, and I think it is an indication that a lot of the pain has been taken, and we are seeing evidence now of repurposing and much more activity in that space. But a note of caution on that is that we still have quite a lot of government support in the system, and as that starts to be removed, we might see some further bumps ahead. But I think they're just useful about how things have changed. I'm a valuer. We obsess over these sorts of charts. This shows how the sectors have changed since the start of the pandemic. Now, the trough point was about a year ago, where at the all property level we were off close to 8%. But as I've said, there were very wide variations in the sectors. We've recovered most of that value now, so we're about 1 to 1.5% below on an aggregate level where we started. But again, I just want to talk about this divergence. All shopping centres minus 37%, and that's on average, remember. So within that, there will be centres that have declined much more than that. The other side of the coin, nearly 25% growth in industrials. So you've got this, this clear relationship between the two. Offices have actually been really quite calm in comparison. Office values are off, but not significantly, and we're starting to see evidence of activity returning to the office market, probably led by some of the regional cities, but even now at the better tiers in London, and I'm sure that'll come up later on. Let's look at liquidity at the investment market at the macro level. Again, very clear in the depth of the pandemic. Q1 2020, Q2 2020, very subdued marketplace. People were having real problems trying to underwrite deals, and we saw transaction volumes really fall back. This year has been different. We've now got, if you look at Q2 and Q3 this year, we're pretty close to 10-year average levels of trading, and I think certainly I'm picking up that the last 6 or 8 weeks of this year is going to be quite busy as well. So there's a lot of capital around. Real estate remains very attractive. The banks have returned this year. They were largely absent last year, and I think that's driving that activity, and that must be good news. If you break it down, again, this theme of industrials come through. The DHL's at 1.9%, but you can see industrials makes up a much higher proportion in 2021 than it did pre-pandemic. So industrial trading is 30% higher than it was in 2019. Interestingly, central London offices, which is traditionally a big part of the market, is slightly behind at the moment. But again, I think that is likely to change as international capital starts to flow again as travel restrictions are moved. So just a quick run through. Office occupancy remains stubbornly low. We do have a high vacancy in London, but regional locations is much higher, and we are starting to see activity tick up. We've got record levels of demand in the industrial logistics space. Rental growth is coming through, and those yields remain under downward pressure. I'm glad to say that rent collection has materially improved since reopening. We had this rather strange phenomenon in the pandemic in my career where people were actually not paying their rent, and the government were allowing them not to pay their rent, turning a lease contract into an option agreement. Rather extraordinary situation. Thankfully, although the moratorium still is in place, it does. I take quite a lot of comfort from the fact that rent collection stats are much better. Out of town retail back in demand. We've seen 15% plus capital appreciation in out of town retail in the last 3 months or so. Lots of liquidity. People prefer the format. A lot of the pain within the rents has been taken, and there's a real reset going on there. Shopping centres and high street are less liquid at the moment, but as I hope I've indicated, we think they're stabilising, and that's all about the rents having adjusted to a more sustainable level. There's lots of activity in the residential sector, in the build-to-rent sector, and there's also significant capital, global capital, trying to get in. So that's a snapshot. I can't stand up and talk about the market without referring to sustainability and ESG. In my career, I've never seen an issue rise to the fore as quickly as this, and thank God it has. With the climate emergency that we're facing, it is starting to impact the market. It's on, as you'd expect, it's on top of everybody's minds. Very simply, tenants are on this. They're much more aware now. Many more people have signed up. Companies have signed up to science-based targets. They will be looking very closely and are looking very closely at what it means for their real estate occupation. And that will obviously demand for space, the amount of rent people are prepared to pay. Investors' demands are also materially different. There's pools of capital being raised specifically to invest in green product, and there is all the major banks have got products available that give pricing advantage where certain criteria on sustainability criteria are met. So that will flow through to pricing and value advantage. And we have got a wave of regulation coming down very quickly. And I won't go into too much detail on minimum energy efficiency regulations, but there is going to a significant amount of retrofitting to meet new standards will be required, and it will be required over the course of the next refurbishment cycle. So there's a lot of people spending a lot of time thinking about this, and as valuers, we are now really starting to be able to observe that in the marketplace and unpack that relationship between sustainability and value. I'm going to sort of end with something I referred to earlier. Despite the fact we've got inflation in the system, despite the fact we expect an interest rate rise, we have got historically high spreads between property yields and gilts. That implies to me that real estate will remain attractive as the recovery gains pace and people become more confident about the income component of real estate. I expect that demand to continue, and I think this chart shows that we can withstand and absorb some marginal interest rate rises without too much impact on our markets. So yield gap remains historically wide. We've got loads of equity available. My belief is London still is a resilient centre. The activity is rising, and there is a limited development pipeline. So I expect that occupational market to come back relatively quickly. Unprecedented demand for industrial and logistics and increasing demand for residential. And people haven't really started getting on planes yet. And I think when the global capital can travel more freely, I think we'll see more activity in the market. And then the final point is ESG and sustainability is now really at the top of the agenda. So that was my snapshot. I think I'm handing over to Deepa.
Thank you. Great. Well, I only have one slide, so we'll kind of talk through my one slide quite a bit. But just a quick introduction. My name is Deepa Devani. I have joined PSP about 2 years ago, and I'm responsible for UK and European investment and management of the assets that we acquire within that. And it's really kind of all sectors, and we'll talk through how we kind of think about that. Prior to that, I was at GIC for quite a while, so same thing, different government for a very long time, and I also graduated from Cambridge a very long time. So PSP quickly is one of Canada's large pension funds. We've got over 200 billion Canadian dollars assets under management, and we invest in everything, public and private asset classes, and within private asset classes, we've got private equity, private debt, infrastructure, real estate, natural resources. So we cover a wide range. And PSP's money is really investing the public sector pension of the Canadian armed forces, mounted police, public sector. So it's quite a wide range. And at the moment, we are kind of in deployment mode and growth mode, which is great. So we've got, a good run maybe till 2030, 2035, before we get into a net, income phase where we'll then have to start deploying capital. So the position that we've got, especially now for real estate, is excellent because we can choose to invest in whatever we want, but it's also almost manufacturing core. And that gives us a lot of optionality to get excellent returns, development type returns, value add returns. And then we have an optionality at the end to exit or continue to keep it and reap the benefits of that income. And I guess the way we've got offices in Montreal, New York, London, and Hong Kong. So we cover most of the world. Montreal covers all of the Americas, which is about 2/3 of our real estate portfolio. And London covers UK, Europe, and Asia. So we've got a small team in London, about 15 people, and we do all three of those kind of regions and acquisitions and asset management within that. And so really the way, before I kind of show my one slide, the way we kind of think about how to invest or where to invest, probably in our London office, for example, and then we talk globally. You look at all of the market intel that's coming to us in terms of the macro and the sectors, etc. And we really try and focus on three success factors. So the first one is really market beta. So we try and find the key markets within UK, Europe, and Asia. What are the key markets? And then within those, what are the sectors that we like to capture that beta? Then we look at the alpha, and the alpha that we're going to try and generate is two ways. We always partner with local operating partners. We're a small team. We are capital providers, not silent capital providers, but still, we need people on the ground. We like to do business with partners in JVs or club ventures. We do funds, discretionary funds, but that's a very small part of our business. So it's really, we want to have control and we want to have governance and liquidity options. So it's usually 50-50 or 90-10 in certain instances. And then obviously the third one is asset selection, stock selection within those, once you've selected the partners and jurisdictions. What are the business plans? What are we looking at? Now, COVID-19 has obviously accelerated all of these trends. We were always thinking about these trends, and I think that it's just accelerated all of those trends. So what we found is what's happened now compared to GFC is how it's COVID has affected the way people consume real estate. And that's really important within all of these sectors that we talk about. And so if you look at, if I kind of talk through all of these sectors and, what we've invested in within that. So if you think about urbanization, that was all obviously happening, movement of people and what's the impact on real estate. So the debate we were now having is, what's the importance of the cities now? What's the role of the cities? Is it a hub and spoke model? Is London going to come back? What's going to happen? How does London compare to Berlin or Paris or China or, all sorts of things? Change in tenant behavior and impact on building design, ESG, how are people going to use space? Is it going to be more space they need? Is it going to be less space they need? Densification and mixed use of real estate, live, work, play. Are we going to still say we believe in a city and we're going to develop a big mixed use scheme as we're doing in Milan, where you've got offices, you've got retail, you've got housing, you've got a university. So it's kind of all of that debate. Innovation and data. AI, technology, how are people using that? How are they consuming that? What does that impact us? How do we use that in our real estate? We've got big resi portfolio. How are we going to use technology? In the US, it's a bit more than here, where you've got single family rental. How do we find partners who are using technology to grow our SFR platform? Knowledge clusters, it's one of the shining, life sciences. Everyone talks about it. People are paying crazy cap rates in London on the back of this. But how can we benefit from them? We've got a very big life science portfolio in the US. How can we replicate that here? Can we replicate here? Because we still do need higher returns. Can't seem to access it because people are paying low cap rates. But what do we do about that? And education, the demand for education is rising. During the pandemic, obviously, there was a question about student housing and, is this a structural shift where people are now going to study online, or is it the experience that they're going to crave? And, I'll talk more about how our portfolios are being performing. Shifting demographics. And this is really interesting. So, aging population, tech-enabled generations and reduced home ownership. So, this covers quite a lot of things that we access: healthcare, medical buildings, hospitals, nursing homes, senior living, active adults, creating communities where older people want to live together because they now probably need more support, loneliness, or is it that actually they don't want to live in nursing homes because that's where the spread of COVID is, so this is the debate that you kind of need to have about this. How does it work versus a rental model on senior versus kind of the buy model? Reduced home ownership and it's the residential. We've got big residential portfolio both in the US and here and in Australia now. And how is that impacting what we do in terms of the investment, development, increased construction costs? How are we going to change the design? Supply chain issues, how is that affecting all our developments, etc. Technology and e-commerce, we've talked about this a lot. What's happened to the supply chain, and how are we going to take advantage of these issues through the assets that we invest in? Changing consumer needs, industrials being a star performer during COVID. We've now started doing some last mile logistics in the UK. And then remote working, are people going to go back to the office? Are they going to stay at home? What does that mean for the offices that we own or the residential buildings that we're developing? And then obviously globalization. How are people moving and how's that going to change? Is travel actually going to come back? Is it going to be business travel more leisure? Do we invest in hotels, international hotels, domestic hotels? What do we do there? And then obviously kind of the nearshoring and internalization. So, this kind of covers probably all the asset classes and kind of all the issues. And this was a slide that was done pre-COVID. So we just kind of change it and debate around it. And if I think about all of these and then how we've invested in it, what we've done is taken all of this and focused on three sectors. So the first one is residential. And then residential will cover build to rent, single family, senior, student housing, manufactured housing, as they call it in the US, or caravan parks here. So if I talk about all of those, we like to develop. So we are developing residential in London. We've got something in Milan. We're looking at Europe, obviously very large in Canada and the US. And then single family is kind of, again, large in the US. And then we compare it. How does that work with single family here? The spread on the yield on cost to spot cap rates in the US are so wide. And so when we're looking at deals, we compare a deal in US and compare a deal in, somewhere in Cambridge, for example. And we'll say, okay, well, the spread there is, 200, 300 basis points. In the UK, it's probably less than 100 basis points. Why? Land is just expensive in Europe, right? And so you're never going to get that spread. Do you still want to invest in it? Yes, because then you talk about income, sustainability of income. It's a strong income. European cities are small. They're always good. People will be living in high rises. It's not that you can spread out. So do we go into multifamily in Europe and single family in the US? How do we do that? And I think that's really exciting because when we sit on our investment committees, we debate all of these. Our US colleagues will be like questioning us on certain offices. We're investing in quite a lot of offices in UK and Europe. In the US, the return to office is even worse because I think people have bigger houses. They have to travel further, etc. So the impact on offices in New York is significantly worse than what we're seeing in Europe. London, yes, it's kind of still slow to come back, but it's not as bad. So there's always a nice challenge that we get on a global perspective. So that's kind of residential, and the other one is student. We've got a very large portfolio with Greystar in London. It's called Chapter, and we focus purely on Zone 1 and Zone 2. And our thoughts really at that point were, do we go regional or do we stick to prime cities? And if we stick to cities, do we just do London or do we do gateway cities in Europe? So it's kind of the debate. And given it was prime London, Zone 1, Zone 2, most of our students are coming from India, China, the US. That just wiped off during COVID. So we had huge NOI destruction during COVID, but it wasn't a permanent value impairment. It's come back pre-COVID levels, rents are higher than COVID. So that kind of says it's not a structural shift, temporary shift. That risk still lies, right? So we still need to consider that when we continue to invest in student housing. But it's a sector that we really like. It's a sector that we can actually tap into on the China growth story, right? So we do, we invest in Asia, we invest in developed Asia. We've got stuff in Australia and New Zealand. We're looking at Japan and Korea. So if we think about China, how do we look at China? We've got investments in the logistics sector in China because that's the best place. But we can access growth in the Chinese growth by investing in UK student housing. With the growth of the middle class, they're coming back and they're paying great rents. So that's how we think about it. And then the other two is the office. Obviously, all of this kind of affects it. Traditional offices, lab spaces, and what we've been doing quite a lot of recently is studios, film studios, studio production facilities, etc. Again, we've got a large portfolio in the US, and we're bringing that to the UK. So that kind of falls all around trends there. And then logistics, I don't need to say more, we've got last mile and bulk. And I guess the final thing to think about when we're thinking of investment is there's so much competition with capital. There's a lot of capital, a lot of pension funds, sovereign wealth funds, and debt, private equity funds. So what we've been changing is saying, right, we're going to go into more operational assets. We don't mind taking development risk. We don't mind taking operational risk. We're happy to invest in platforms, in complex transactions, because we know, I think, real estate is really evolving to be more service-orientated platforms where they're not just tenants or occupiers, they're your clients, they're your guests. And so if we can control the delivery of that service by owning those service providers, that will give us some interesting competitive advantage. So rather than just being traditional landlord. So I think I'm running over time, so I'll stop there, but happy to take any questions later.
Hi everybody, I'm Stephen. Marita, I sit on the debt team. I've still been with the firm for about 11.5 years. I'll be kind of going through kind of UK and European debt markets today. Please bear with me, I haven't had a full copy yet, so we'll get through here, okay. So we'll just start kind of with the general backdrop for the economy, both UK, Europe, and kind of globally. Obviously, coming out of COVID, we have seen an unprecedented amount of stimulus. We've had about 4 trillion monetary stimulus in the US, 4 trillion monetary stimulus in here. Plus, we've had fiscal stimulus kind of across the globe, but most notably, close to 6 trillion in the US prior to Biden's most recent proposed continuation of unemployment benefits and the rest of it. On the back of that, we've obviously seen a fair bit of global recovery. I'd say the US is leading the way in that sense, just given the sheer amounts of fiscal stimulus they pumped through the system. Whilst you've got kind of Europe, where you've got a bit more of a fractured, well, not fractured, but separate governments, significantly less amount of stimulus than the US. For kind of reference, that 5.6 trillion of stimulus, that's about 25% of US GDP. So we really have seen a lot of strength just in the recovery because of that. When we kind of think about real estate and think about the kind of impact all of that has, the U.S. debt markets specifically, because of all that monetary stimulus, because of all that money that's flushed through the system, the U.S. debt markets recovered very, very strongly. That comes across not just in real estate, banking sector, tech, healthcare, et cetera. So that's really, really been a positive for asset values, I'd say, across the U.S. And that's something that we expect or we hope will come to Europe. It will be very interesting to see. You've got the U.S. who's got this huge kind of sugar rush between new low rates, all this stimulus, and you've got Europe who's already seen low rates for a long period of time. And we haven't had that same kind of scale of fiscal stimulus. I think the messaging here, and this is kind of an overview which we'll kind of go through, but really we use the U.S. as a barometer of what may happen in Europe. Given how strong the debt markets are in the U.S. and how much that's led to, I'd say, asset recovery in terms of values and just liquidity and transactions, we expect that may come to Europe here in the next kind of 6 to 18 months. We'll cover a bit around CMBS, alternative lenders, different parts of the commercial real estate debt space, but that's kind of the backdrop which I want to start with. So as described, when you look into commercial real estate debt markets, you've got different legs of the stool, all with different types of capital that can underpin them. For debt funds and alternatives, those are generally the Blackstone, Starwoods, those types of groups. And the smaller scale, the ASKs, the STARS, the debt funds that you may hear about, they're raising private capital to effectively lend on assets that may be a little bit more opportunistic, a little bit more value add, secondary locations. You've got life companies, those are insurance companies who may have longer term liabilities that they're trying to match with loans that they put out. Now, a lot of life companies are kind of doing shorter to medium term lending as well. You've got CMBS. CMBS is a good, I guess, a good barometer, a good way to kind of gauge risk. CMBS in the US is very liquid, and you can kind of see every single trade, how that kind of, they've got risk tranching all the way through. Some people may have a negative connotation with CMBS due to the GFC. You would be wrong. But from our perspective, the CMBS markets really kind of come back strong, and you can use the different tranches to kind of gauge how different people view risk across the spectrum, across sectors, et cetera. You'll see where there's a difference here in the US. I think we've seen the banking market recover very strongly, whereas in Europe, I think we're kind of starting to get there. Banks are starting to open up. They're probably not taking about as much risk as they would have taken pre-GFC, or excuse me, pre-COVID. When you think about, do they take leasing risk, do they take development risk, all of those types of things, those are parts of the market where we see them still being a little bit more cautious. So, but to that end, When you look at this, let's say 120 and 103, but this graph is effectively comparing New York Stock Exchange or New York financials to European financial companies. And really what this is, the banking sector is a bit of a reflection of the health of the underlying economies, how much people expect interest earnings to be able to go up over time as economies recover, et cetera. So the main point of this is just to say that the U.S. financial services sector is leading Europe. When you've got a strong financial services sector, that means that spreads are lower for borrowers. That means there's more availability of credit. So we've seen since COVID, the U.S.'s recovery has outpaced Europe so far, which means, prospectively, as European economies recover, you've maybe got a bit more room. Up here, we've just thrown a bunch of kind of indicative or kind of high-level core pricing. So what these are spreads that borrowers would be paying across the different sectors, logistics, office, et cetera. And we've put ranges or kind of estimates for the UK and the EU. First of all, these are all kind of probably about a couple months ago. So if anybody has any objections, feel free to take it with me later. But they generally have, I'd say healthy return. We've had a healthy return to kind of core lending from most of the groups that you saw on that chart or on that previous page. In terms of senior LTV cutoffs, most groups are still staying within kind of what I would say is moderate to conservative leverage levels. We're starting to see, as Grace kind of pointed out, we're starting to see a lot of differentiation between sectors. So, logistics, people may push on leverage. Multi-housing, people may push on leverage, whereas if I didn't put retail up here, but you think about retail, you think about hotel, people are being much more conservative, and that's really going to impact the various sectors within the market. One big observation that we've made here, and the takeaways down at the bottom, when you look across the spectrum, core spreads, how much you can borrow, and at what rate, they're still below where they were in 2018. So I think our view on the East Hill side is that whilst you've got liquidity back in the market, you've got a healthy functioning market, another way or another kind of perspective upside for values is actually through margin compression and through spreads coming in or senior LTVs going up. So I guess to end that out, I think if you ask me what were 2018 lows or kind of where directionally could you get to, I'd say probably, for the UK part of this chart, I'd say 1.25, 115, 120. So, probably incremental 40, 30, 50 basis points of savings depending on your sector, et cetera. On the EU, I wouldn't venture a guess. It's a bit of a broad range going from Germany to Germany all the way to wherever you want to go. To kind of take a piece on the CMBS. So what this is for those of you who aren't familiar with CMBS, you see there's different tranches. They've got different ratings kind of across the piece. Those are ratings by credit agencies. Each individual securitization will get rated by 1 to 2 parties. And really what they are is, the AAA pieces are always, they're always the safest pieces. As you kind of go down to BBB minus, that's your investment grade cutoff. And then you've got single B and double B thereafter. AAA is effectively a government bond, or that's meant to be the proxy for. You'll see in the upper left, you've got a portfolio kind of logistics. On the right, you've got a life sciences portfolio that Brookfield did. Generally speaking, 2 very strong issuances, strong borrowers, good. I'd say just got a good story behind the whole issuances. When you look at those AAA tranches, we would say that's usually you kind of a look through LTV to properties of about 35 to 40%. When you try to take the entire capital stack, you can probably see there it's kind of 60 to 65% that gets securitized on an LTV look through basis. But for the first kind of AAA tranche, you're looking at kind of spreads inside 100, which means if you were to say, Stephen, what do you think a AAA or an appropriate risk coupon is for kind of a for the LTV look through deal, I would say the CMBS market says 100. The banking market right now probably says that 140, 130, 150 range, depending on how you get to. So I think what we're finding, and this is obviously kind of a positive for everybody, is that CMBS is acting as a good conduit for certain types of deals. It's kind of larger deals with diversified cash flow. But what we're seeing is that CMBS loans will price inside of where the banking market will price loans by a considerable amount in some instances right now. So healthy sign, definitely allows you to kind of look through and do a kind of compare and contrast and kind of maybe to wrap it all up. If you use that left example, someone's borrowing 65 LTV at 157 in terms of a distribution to CMBS bondholders. You've got to add on running costs and a few other things, but generally speaking, that's probably 25 to 50 inside of where I would see a bank market deal. This slide is meant to just kind of compare market share of alternative lenders. Traditionally, you've got senior banks and investment banks as the more common liquidity providers in the commercial real estate world. But what we've seen over the last few years is just how much alternative lenders, insurance companies have, really, I'd say, been aggressive in taking market share, have been more supportive of not much, I guess, in two ways. One, doing deals that banks have probably become more conservative on, and two, just being more aggressive in terms of willing to do financing that maybe, typically wouldn't have fallen within anybody's lending criteria. But what we've got here is on the left side, you've got, this is a breakdown of actually our firm's debt team business. But on the left side, you've got kind of a breakdown by percentages of our 2018 financings. I'd say in 2018, you're starting to see kind of debt funds emerge, but it wasn't really as prevalent as it is today. Over the last few years, you've seen a lot more capital raised, you've got a lot better kind of technology behind how these debt funds fund themselves, whether it's repo, whether it's loan, whether it's other kind of structured methods. But once you kind of get to where we are today, 2021, we see that part of the bank or that part of the market alternative lenders, insurance companies being about a third of all the deals we do. I think from our perspective, one, we probably expect that to continue. More flexible capital, people who can offer more unique structures. We don't have the same banking regulations that a traditional senior bank would have. And also, two, just kind of by virtue of where the world is going, huge demand to kind of have conservative capital that's not yielding 0%, sitting in a bank account, not yielding 50 basis points, being a AA, single A risk, a traditional corporate bond. This, we think that these types of lenders and investors will continue to be prevalent throughout the market. I think this is my last slide here, but this is effectively a story, or I shouldn't say, this is a story that have or have nots is kind of, but what we're seeing across the lending spectrum is just there's an increasing divergence between pricing and liquidity and just general appetite to even consider transactions between, thing on the left, thing on the asset sectors on the left, and sectors on the right. What does, and this maybe ties into Deepa's presentation a little bit, what does everything on the left have in common? Lots of this stuff is tech driven. You've got data centers, you've got life sciences, you've got logistics. These are all sectors that are partially driven by advancements in technology, whether it's health related or whether it's related to retail. I think we're seeing just people value that kind of future growth and then obviously future proofing, but that within real estate. On the right, conversely, you've got things like low ESG assets. I think one of the things that we're finding across our company, we've got a 500-person company that's about 80% US globally, 20% Europe or so. But we're seeing there's a huge, kind of a widening spread between, something that's a long-let core ESG office and something that's a, secondary office that maybe isn't ESG friendly, or you're going to have a tenant rollover in 6-7 years and you don't know if the space will be viable or how the space or demand for space will look at that time. So certainly seeing just divergence across sectors, but also subsectors within each of them. I'll wrap it up there. I think that's my last slide.
Great. Morning, everyone. I'm going to try and read this on the phone because we're very modern, so excuse me. My name's Dan Nicholson. I just started work at Great Cornwall Estates about 6 weeks ago. I have responsibility for the existing portfolio and our development programme. So no difficult questions, please. I feel very lucky to be allowed to do this, having been sort of 6 weeks in the job. But I took, between my last role and this one, an extended break, which was very interesting because part of the driver behind that was to think about all the issues that people have been talking about today and getting a little bit of true objectivity, which you can't really do when you're working, about many of the themes that are driving business today and driving life, and really how those apply back into really what we're all doing in this wonderful industry of ours. So having had a look at that, I should have a fairly objective view about what's driving London. Great Cornwall Estates is an office investor and developer. We're very much focused on central London. And I think people have been talking about the footfall statistics, which probably contradict what I'm about to say. But you just walk into the middle of the West End, having had, say, 6 months in the middle of nowhere, coming back into London, you can just feel the energy and the vitality. So the themes I'll be covering in the next 8.5 minutes is getting back to the office, sustainability and customer service. So coming back to that London that we talked about with the albeit lower footfall, it's just completely evident that being in here in a room with a bunch of other human beings is absolutely fantastic. It's a great break from what we've been doing for the last almost 2 years now. And I think we've all sat in meetings with colleagues, intelligent, inquiring minds, and we've been able to get through things far, far quicker and more efficiently than we do sat behind screens and sending each other emails or WhatsApps, wherever it happens to be. So as an office investor and developer, that's absolutely crucial. And I think people have perhaps forgotten, and I know there's a bunch of people, and I'm just sorry offending all of you at once, but attending digitally, but certainly being here, I think is a big difference. And I think we really have to encourage people to get back into the office for those wonderful creative moments that we all have with our colleagues. It's interesting, Generation Z, if you get a newspaper every day, they're the ones who always get an absolute hammering from the press for being feckless and undecided about what they want to do, which I think is completely unfair. If you actually look at the statistics, Adecco, the employment company, did a big survey. They interviewed 14,500 people globally and in 25 different countries. So it's a proper survey. It's not just the Times walking out to the street and asking 10 passers-by. This is a proper survey, and actually of all the sort of age regions, if you're allowed to categorise that, Generation Z were the keenest to get back into the office. 56%, they were the highest, which I think is absolutely fascinating. It really sort of says those are the people who want to get back. They want to learn. They want to set down, bonds with their colleagues about advancing their careers. There's a whole world that you're far more inquiring at that age generally about what lies ahead. And so that's really the generation that wants to get back in. And I think the people of my generation, X, etc., we could probably take a lesson from some of those younger people about their zeal to return back to the office. There are obviously some discrepancies about sort of home working, office working, and I don't deny that hybrid is definitely the way forward. And we are going to be having some time where you need special thinking time to take that away. But interestingly, 85% of those workers who were actually interviewed in that survey said that they felt they were more productive during lockdown than they were previously, or as productive. Not entirely sure I believe that. We've all been there, on a nice sunny afternoon, sat at home, you turn the Zoom off and look out the window and think, well, maybe just a little walk around the garden. And I think that's something that's probably borne out through most people's experiences. If we're all honest about it, I don't think that productivity statistic is perhaps as true as it might be. The flip side of that is 45% of the managers who were interviewed in that survey, they said that they were finding it extremely difficult to motivate their staff and to get their sort of team ethos and their business plans across to people. So I think that slightly cuts across the productivity statistic. But I think at the end of the day, there is a new, as everybody has said so far, there's a new method of working. As a business, at GP, totally open to this. We recognise that there's going to be new models out there for people to occupy offices, and we're very open to listening to that and talking to our customers and seeing how that's interpreted in a physical way across the type of buildings that we're going to produce, or existing buildings that we're going to sort of refit to accommodate those needs. Sustainability has been mentioned a couple of times. Obviously, I mean, having been away since 6 months and come back, what everyone said about sustainability completely rising to the top of the tree in 6 months, it honestly felt like, in that respect, sorry, I'm meant to be showing my slides, sorry. Yeah, this is the office you don't want to go back to. This is the kind of office I started in about 1994, so let's not do that. Let's go to these wonderful design places with cool people. And these are some of my colleagues, so I have to be very, very nice about them. But this is what this is what we want to go back to. Places where you can sit, exchange ideas. So sustainability, yes, completely risen to the top of the tree in 6 months. I mean, honestly, I felt like I've been away for 10 years in the way that that's come back as one of the primary drivers of what businesses do. I think we're past the threshold where we all recognise now it's absolutely intrinsic to our business. And I don't know whether my personal view that this is sort of business as a whole has almost felt like it was trying to get away with stuff. And I'm not talking about real estate, but now you come to work and you talk about sustainability. Business now talks about sustainability. It really means it. It has become something that's totally key to what almost everybody does. And so the days when it felt it was a sort of thing you had to sort of talk about and then put away in a cupboard again until the next investor meeting, that's all gone. And I think that's brilliant to see that that's completely changed. As Nick talked in his statistics about the valuation market, the investment market's already showing a delta in pricing, and one of your competitors, not as good as you, obviously, has done a brief survey about the delta in value between sustainability facilitated office products and those which don't meet that target. Stephen's also talked about what's been able to be lent upon. There is now a proper gap between those two, and I think perhaps in the longer term, assets which don't meet sustainability targets will be almost priced like land, obviously with a small addition back for what you can reuse in terms of the existing building, but that delta is growing and will get bigger and bigger and bigger. And at GP, this is sort of front, right and centre of everything we do. Sustainability is key. All the developments that we've got are totally focused on it. And I think as somebody who sort of view of the external acquisition market, I think we've got to be kind of interested in saying that actually provides a massive opportunity for people who are totally sustainability focused. Those assets will go down in price, and there will be opportunities to take those sort of sad, broken buildings, ever more than was the case, and put them back into really sort of top grade buildings which meet all the sustainability criteria, which are quite rightly set in legislation, and as my co-speakers have pointed out. There we go. There's one we did in Newman Street, number 1 Newman Street. That's our terrace on the top floor. When was somebody 10 years ago looking outside, green walls, such like, I mean, it's just now de rigueur. And then this is a building which we've got 50 Finsbury Square in the city. We just done a pre-let to Inmarsat, and they retain the structure. This is obviously before I started, so I can wax lyrical about it, guilt-free. But they've done so much in terms of trying to put back, keep as much as you can of the existing building, and I think that becomes ever more of a focus for every developer that's active in the market, and particularly us at the moment. We shout about this building because the statistics there about what we managed to reuse are absolutely wonderful and great to see for the benefit of the entire sustainability movement. And there's a little sort of cut through of the existing building showing effectively what we managed to save relative to the old building. So like all the frames effectively and the floors. And there's some more detail of the development you can probably see out of the window just across the way here. What we're trying to do, this building, and some of the intrinsic features we're putting back into a development to try and hit those same criteria. I won't go through the detail. Please feel free to read them. But again, very indicative of what's been trying to be done to advance sustainability in the office market. So the last theme I want to talk about is customer service, and from a lending perspective, Stephen touched upon it. there isn't the old days of there was a famous quote by one office owner who said in a discussion with and I use the word tenant reluctantly, they said, I am the lord in landlord and you are the ant in tenant. And this is the end of the conversation. That's circa 1970 or 80 perhaps. That's how the relationships were between sort of landlords and tenants. And I use those words because they're no longer used. We don't use them anymore. Owner, customer. And the whole industry is moving from B2B to B2C. That's completely evident in everything that we do. And that model where you used to have a sort of agent showing you around, and there was a big argument over negotiations, an argument over the lease, argument over fit out, and by the time a poor tenant, and say use it in a historical sense, got into a building, they were exhausted, they hated the landlord, and they were already looking around and thinking where they could go to get away from this devil who let them the space. That's completely out of the window, and we as business are completely looking to change that at the moment. We would like everything all the way from the moment that somebody thinks about moving to the day they hopefully don't leave, and that's the key to this thing, because keeping your customers in your buildings is key to revenue retention. That is all as smooth as possible. We launched a building a couple of months back in Duffield Place in Soho, very, very high levels of service. We've got somebody on site who effectively is our customer care person. Anything they need or want, they call us up, not necessarily that you can provide everything they want, but you see what you can do. Every question that they ask, we will do our best to answer. And we totally see that as the future of GPU's business in central London. We are all, as an industry, going to have to shape up to this, otherwise we're going to get very badly disappointed about what our customers will say very publicly about us, mostly electronically. But we see it as absolutely core to what we do. And the customer service philosophy is going right the way through our business. And in every project that we do, every refurbishment that we do, every development we do, we'll be offering that as really core to the future offering of those buildings. So that's it. Three themes from somebody who's been sat out in the ULU for 6 months. I'm happy to answer any questions. It's nothing too difficult based on 6 weeks. But yeah, please let me know afterwards if you have any queries about what Great Portland Estates are up to. Thank you very much.
Don't worry. Well, thank you, everybody. I think you'll all agree, as ever, that there are an exceptional degree of content in a short space of time from some excellent professionals there. I'm glad that Dan has finished with this building. This is actually a Great Portland building, and I'm going to do a GP bit for you. I worked in this building for about 15 years before they got hold of it, and it was rubbish. Now it's lovely. Well done. It's just on a sort of a personal note. Okay, we don't have too much time. I mean, we heard an awful lot there. I would like to mark one thing, having sort of stood before this audience for quite some years now, is that the so-called ESG agenda. I remember writing, I was commissioned to write a report for a big firm of surveyors about 10 years ago about this, and I wrote all about the potential obsolescence of low-grade energy buildings and greenwashing and all of these things, the enormous market potential that may be in retrofit, the separation that was likely to happen in values and spreads and all the rest of it, and all they did was put it on the shelf. And I was quite pleased to write it and so on and so forth. But this actually marks a turning point in our industry as far as I'm concerned. This is the first time at this event that we have actually seen the green agenda actually become core and centre to what we are doing, rather than something we need to mention as being a market factor. And what's also encouraging or otherwise about that is that one of the reasons for that is that market forces and sentiment and everything else are actually now driving that into actual value. What we're seeing in the property market now is increasing diversification, as we've heard, increasing heterogeneity, as it were, because if we look back over the past, the post-war era, property as a sector has largely been fairly homogenous. It tends to track the economy at the macro level. You look at the lines on the graphs, whether it's yields or rents or whatever it might be, take up, they tend to broadly track each other. And yet, as we saw from Nick, and also from the capital markets as well, that disaggregation between the sectors is now becoming much more pronounced. So it actually, in real estate, it really does matter which horse you now back. didn't necessarily used to 30 or 40 years ago, because you'd ride the cycle. If you got it wrong, inflation would dig you out of a hole, you know, upsides and downsides. Of course, there were local market stories. But the sector has now become much more diversified, much more sophisticated, and we have to become much more intelligent, in my opinion, about interpreting the detail. And we can obviously see from the investors here and so on that's obviously been happening. And that disaggregation in value, I think, will obviously continue into the future. And arguably, well, it jolly well should. It's about time the real estate industry really did catch up with this carbon imperative, if I can call it that. We've been talking about it for at least a decade. We've been greenwashing for a decade. Now we have to do something about it. And we jolly well should. And I don't want to sort of be too altruistic. The other points that I took away from, this morning was, it's very interesting to see a Canadian pension fund interfacing with the market in a much more dynamic way than perhaps investors from that sector might have done historically, where there was always a search for annuity style returns in vanilla sort of situations. And actually, with the sector becoming more sophisticated, more dynamic and more disaggregated, there's opportunities there to play in certain markets, go into joint ventures and partnerships and so on. So we've seen increasing amounts of institutional money becoming more dynamic in its interface in pursuit of returns, as it obviously interprets what's happening in the market. But I'm going to sort of stop there because we've got time just for a couple of questions, I think, if anyone's got any particular observations. I would obviously like to thank my panelists here this morning who've done a magnificent job, and so on and so forth. But if anyone has a question or observation, that would be very welcome. So,
Steve, sustainability comes at a cost, and there's a lot of talk at the moment about increased building costs. I'm just wondering what effect this is having, and whether there's empirical evidence about its effect on development starts.
I mean, there's certainly a capital cost that's clear. For example, the Finsbury Square building we talked about, we're using some of the different parts of the building in the new building and having to treat them to be reincorporated. So there's a labour cost, transportation cost. And that's just a small example, changing the nature of the equipment you put into the building in terms of M&E, moving from a 4-pipe fan coil building that you would have done automatically 10 years ago with boilers to heat the water and chillers and such on the roof to cool it. It's kind of out of the window now, and everything is electrically operated in the building, air conditions, again as a capital cost application. So obviously dependent on the type of building constructing, and I think people are finding their way through that. But there's a definite premium to be paid. In terms of looking at the more structural pieces, there's constant scientific investigation into how do you just not put back, for example, ordinary concrete or ordinary steel. Without going into too much detail, there are now products you can put back in both of those categories, which are more environmentally friendly and more sustainable. Again, there's a capital cost to that. So I think there's there's a sort of almost an index of the cost, probably be mistaken, because it's obviously scheme dependent on what you're doing with each individual building, but you recognise the cost, and because it's a necessary part of what you have to do. Flip to that is there's a rental premium, almost a rental premium. I'd say that's going to get bigger as customers become much more focused on the space that they occupy as meeting those criteria, and there is also capital value premium too. So yes, there's a capital cost, but it's outweighed or balanced by what there is in terms of rents and values.
and don't we think that when we look at that in detail, I think one of the sea changes that we've seen is that people will pay more or better. It used to be the case that there was this kind of a wish list and things. We want an absolutely wonderful building, but we don't want to pay any more for it. But I think that's now changed. I'd also like to raise the issue here of labour market forces and also well-being, because the green agenda, if we can call it that, is also linked to individual personal well-being. And that has been heightened incredibly by the pandemic. So we now have a very, very powerful dynamic, particularly amongst Generation Z, who are looking for something that is appropriately profiled from an ecological point of view, but also appropriately delivered and profiled from a that's where I want to work point of view. And that's all about well-being. And those labour market forces are going to be incredibly powerful in the future, because that's about talent retention, talent recruitment, which will make for successful companies, and successful companies will want successful space in order to create virtual cycles of increasingly appropriate talent to increase profit margins and so on and so forth. I think that this steamroller is now starting to roll properly, having spoken about it for some years. Any other questions?
So it's regarding office. So there's like increasing trend of having like co-working space, service office, or even some of the landlords are trying to use the vacant space and run the service office themselves. So how do you see this like kind of the industry disruptor in a way? Sometimes they are coming in can basically affect rent. They're competing with the landlord in a way, but at the same time they seem to be adding some additional services to the other tenants. They got the flexibility. It seems to be more like the vibes getting better. You get the nice people, true people in the building. So how do you see it as from a landlord point of view or from an investor point of view? Do you want to have that, or do you not want to have that, or do you want to actually do the business of the co-working service provider as well?
Okay, maybe I can go first. I mean, from an investor perspective, this is a big thing for us. We, and it's the beauty in what we do. We can choose to invest in a traditional office, or you can choose to invest in a co-working operator who has the real estate behind them. So when we look at it, what we absolutely know is that commodity offices are out. We will not be investing in those sort of assets. We do have 22 Bishopsgate that we own, but it's a vertical village, and within that you can have a co-working operator running it, and a lot of tenants like that ability. But there's significant large tenants who just want to take very good quality large space for 10 years. Obviously, there's more breaks now that they're asking for, but they want to take that large space and then have the option of growing or shrinking. On the other side, we have been looking at various co-working operators, and I think the differentiation there for us goes back to ESG, well-being, and the type of operator and the quality of services they're providing. Because I think in London there's hundreds of them, and you can seriously, like with good quality and bad quality assets, there's also a bifurcation in good quality operators and just run-of-the-mill standard operators. So that's been a serious kind of differentiation, and we look at various opportunities. So from our perspective, we're happy to own either buildings that we think have got the longevity and liquidity at the exit, or within campuses. But then also we're totally happy to be investing in businesses, operating businesses that would provide that service.
I'm going to draw it to a close there because I know that some of us are under some time pressure, but thank you once again to the panelists. Thank you all obviously for coming. I'm just going to hand over briefly to you. And what do they say? Well, same time next year.
Thank you, Steve. Normally Roddy Houston would be standing up in front of you, so I'm a very poor substitute. Roddy chairs the commercial forum, and this would come under his auspices. Unfortunately, like many, a function of the life we live, he's self-isolating at the moment, so you get me instead. Apologies for that, but I just want to reiterate our thanks, firstly to Steve, who does just a marvellous job of coordinating this. Thank you so much, Steve, as always, and to our panel, all four good friends, and we're very appreciative of their time of joining us today. And for those online, I hope the messages came over, you were able to see the slides. What you didn't get was the lovely breakfast that we've all enjoyed, which is another reason why coming and doing this in person is immensely valuable. And our thanks to Taylor Wessing, our host today, for looking after us so well. I'll make one comment because everyone else has about ESG. We've talked a lot about the E today, less about the S and the G, and they are as important. And for the first time in my nearly 40 years, we've heard about capital markets, we've heard about the debt markets, we've heard about sectors. Most of what we do, it seems, we learn from or take lessons from the US. 1 year, 5 years, 10 years, 20 years ahead of us. This is something which we can proudly say Europe is actually leading on. Whenever I talk to my US colleagues, they can't believe the momentum it has here. And I think that trend will continue. And it started with the Dutch, and it's with the British, and throughout Europe that's really gaining. It's like a train that has definitely left the station and is going very rapidly. And for us, ESG, even within CULS, has been vitally important. We formed our own sustainability forum. For those of you who joined any of our events when we were only online, we did half a dozen seminars, webinars during lockdown, which were massively well attended. We had one on rewilding, not something I know much about, that over 650 people attended. So don't tell me this isn't real. And in fact, we have 2 events. Savills very kindly have been sponsoring a series, and they're going to do another series. We have 2 events which those of you who've got card here, you'll see on the 2nd of December, one's on climate innovation, and on the 13th of January, early in the new year, on the decarbonisation of the residential sector. Those of you who haven't got the information, those of you online, please go to our website and please join us for those events. We actually have another event next week, which is Javish Patel, who's the head of Norge in the UK, and we can argue, give or take, the largest sovereign wealth fund in the world. It'll be very interesting to see whether he echoes Deepa's comments about asset allocation and how that capital is being moved around the globe. And Lazards are very kindly hosting that next Thursday morning at their offices. Again, details online, please join us. So, as I say, it just goes for me to thank everyone again, particularly the speakers. Steve, thank you. Taylor Wessing. And above all, for those of you who made the effort to come, much appreciated. We missed all of you online. Please come and join us soon. Thank you very much. Have a good day.